Hey, welcome back. Palantir is definitely an interesting one. IPO during the pandemic hype, stock more than tripled in a few months, then it crashed like 80% in a year like the other IPOs, but now, a year after, it pretty much tripled again. But other than the AI hype, is there anything behind the recent jump? A very quick intro, they provide software platforms for big data analysis with an accent on security. Most of the contracts were with the US government or other institutions, but recently they got into the commercial market, which has a lot of potential. I think they offer at least something very important to learn, so let's get into it. They are growing very well, but you have to remember that this is a very small company. Sure, they grew the US commercial revenues by 40% for example, but that's from 107 million to 150. At a $50 billion valuation, this company should be talking in billions, not in 1 or 200 million. The revenue of such a company should be more like 10-20 billion, not the 2.7 billion that they expect. Above that, they see this year's cash flow in the 800 million to a billion area, which can be pretty good compared to 700 million a year ago. They pay around $500 million in stock-based compensation, which is quite a bit considering what the company can make, but even with that, the income from operations went up very well. And look, I get that this is all about growth. You don't buy them hoping to see them make $1 billion, but rather 5 or 10 in a decade from now. However, the cash flow margin dropped significantly lately, so even though they grow the volume, they aren't necessarily making more money. I'm not saying they can't grow. The company can realistically 3 or 5x in less than a decade. With the AIP bootcamps and only 500 customers, there is definitely potential to grow significantly. But we have to think about how much they would have to grow to meet the market's expectations. And if they manage to grow so much, why wouldn't other companies join the market? The balance sheet really worries me. Sure, the current assets cover the total liabilities, which is great, but there isn't that much else left. Basically, all this company has is in marketable securities. Yes, it's a tech company, but do you really not have anything better to do with the money? They invested in treasuries at like 4%. Do they really not have anything better to do with it in such a crucial moment for the company's development? They don't have debt to pay, by the way. And you have to think how much of the company's profit is from what they actually do and how much is interest on these securities. In Q1, about 40% of the net income was interest income, so when you see the margins and stuff, keep this in mind. And a year ago, that interest, which was half of what it is today, brought in all the net income. Also, what happens when rates go back to 0, 1, 2%? So, is the company itself outside of the balance sheet worth almost 50 billion when they can't even make $1 billion in a very good environment? Now, sure, it's a growth stock, but it's currently at more than 50 times this year's expected cash flow. If we go by last year's actual number, the ratio is at like 70 to 80, and that's a very big problem. You know, companies in a very good shape like Alphabet or Amazon are at like 30-40 times the cash flow. And that's still a very high ratio compared to other companies that can make even more money than Palantir. How many times do they have to grow as a company to even be at a fair price? Having to ask this is already an issue. Yes, they did very well, there is a lot of growth potential, low competition, great margins, but even in such a perfect environment, they made like 2 billion in revenue. Buying at 25 times the revenue is crazy. Amazon is traded at like 4 times the revenue. And that's the difference between a stock that is relatively expensive but actually has something behind it and one that's even more expensive but only has potential to have something behind it. You know, for a company that can grow sales by 10-20% per year, it would take forever for this to be justified. Keep in mind that Amazon, a company that makes more than 200 times the revenue, also grows at 10-20%. And again, this isn't the cheapest company out there. I'm comparing them to Amazon, but companies like Alphabet are even cheaper and much more profitable. And you know, what is it that Palantir can do that Google can't, if not do, then buy? The company makes in a single year more than Palantir is worth. Sure, it can keep improving and the stock can keep doing well, but if there are issues or the growth just isn't enough for the market, this is at a very fragile valuation. We saw Salesforce recently report some growth, but it wasn't enough for the market, so the stock crashed by like 20% in a single day. I think this is a very good example of why we have to make the distinction between the business and the stock. The company can do very well, but the stock may slow down because it already grew so much in expectation. They can keep issuing shares and take advantage of the high valuation to develop, but even then, is that growth enough to offset the potential dilution and keep up the high valuation? And another issue, they even say that they have no competition, which isn't literally, it's just a figure of speech to talk about the differences in quality. If this is what they were able to do in such an environment, what happens when Microsoft, Google, Amazon, IBM, Oracle, SAP, Click, Snowflake, Salesforce and all the other thousands of competitors also want to grow in this market? Of the names that I said, Palantir is almost the smallest when it comes to making money. If they do so well, that can lead to companies with a lot of money available replicating what they do and integrating it in their offer, sometimes probably at even better prices if we look at Google, Microsoft, Amazon for example. Sure, they can issue shares for a few years and survive or even do okay as a company, but then when you start looking at a per share basis for profit and stuff, you might see that growth isn't that good anymore. By the time you see this, the market might have already lost confidence, so the stock can really be affected. And this is why the valuation is so important. You know, if they get to, let's say, 2 billion and basically more than triple last year's cash flow, then they are currently at a ratio similar to Alphabet. Why should it be at more? Not to mention that the balance sheet is really unusual. Now let's go through a valuation. In a negative scenario, we can't even be sure that they can make money. Again, they had a very favorable environment, but if they don't get the renewal of some government contracts or there is higher competition, they could even drop into the negative again. It's impossible to predict how much the stock would crash in such a scenario. The market's confidence has a limit, so it's a matter of time. Maybe something like 10-20 billion would be kind of a safety net because then a company like Alphabet can easily buy them. That's a price of 4.5 to 9, meaning a loss of 60 to 80%. They were in this area a year ago, so it's not something unheard of. The thing is, they were making good money back then, so in reality this scenario can be much worse. In a second scenario, let's say they stabilize at around 1 billion in the long term. If they do that, that means they aren't growing enough, so we could see a ratio of let's say 25, which is still pretty high. That's a market cap of 25 billion, meaning a price of around 11.24, so basically a 50% loss. Again, not something impossible. And finally, let's say they manage to quadruple the cash flow to 3 billion. Let's say the market gets them to a ratio of 35, similar to Amazon. That's a market cap of 105 billion, meaning a price of 47.2. That's a 2x from the current price, but if you bought like a year ago, this can even be a 10x. But how likely is such a scenario? Currently, they don't even make 3 billion in revenue, so for a, let's say, 10% margin, because we saw how the increase in volume comes with a smaller margin, plus higher competition and the cut in interest rates, they would need to make like 30 billion in revenue. That's 11 times the current company for the stock to maybe 2-3x. Sure, maybe the margin can be, let's say, 20%, but even then, that's more than a 5x needed. You know, maybe if they continue issuing shares, but for more than just compensation, they can grow, but even then, this isn't easy to achieve. I get a listing valuation of around 20 billion and that one would be very good now, but 50 billion is a bit much. Sure, they have ties with the CIA and the army and stuff, but that doesn't mean they should be worth so much. They became profitable after like 2 decades and the majority of that has so far been thanks to the interest on the marketable securities. Even when you invest in growth stocks like this one, fundamentals are very important. Otherwise, if you just buy at any time and hope that they can deliver and the market keeps being exuberant, that's pretty much speculation. You know, the company can do amazing, it can even triple, but to get to a fair value compared to Google and other similar stocks, the price would barely move. Anyway, this is not a buy for me and they would have to improve a lot for me to even consider them. It's an okay company with potential to grow, but the stock is very different. It isn't on Nvidia's level of disparity between the company and the stock, but it isn't fair either. You know, even at 20 billion, you buy like 3 billion in marketable securities and the rest is a company that in a very good environment can currently make like less than a billion. So this is a very big bet on whether they can keep growing and the competition doesn't heat up, the latter I think being very unlikely. Can the company keep doing well? I think so, but I'm not so certain about the stock. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.